Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. And I'm joined out there in the chat by my good friend Connie Hill, who is all prepped and ready to go to teach this class today in the event that I did not make it to Dallas in time. I'm coming to you from Dallas, Texas, from the Renaissance Addison Hotel. We're getting ready for our technical analysis and options strategies workshop coming up this weekend. So I wanted to get here early so that I could teach this webcast for you. And Connie was ready to go. Connie feels a little bit relieved that she didn't have to step in and teach. So thanks for joining me, whether you're here in the live version, whether you're in the recorded version. I appreciate you being here. And I appreciate you joining into this discussion. And certainly appreciate Connie being out there willing to answer those questions as we get into the discussion today. We're going to talk a little bit about our 14-7 SPX short vertical spread strategy. We're going to talk a little bit about our VIX diagonal spread that we put on. And we'll talk a little bit about the nature of multiple leg option strategies. And sometimes when it comes to trading index options, that can be a challenge. Also, we're going to look at the possibility of putting on perhaps a four-legged strategy today as we get into some of these discussions. So thanks again for joining me. Let's get into a couple of quick housekeeping items as we get started. Remember that everything we talk about is simply for illustrative and educational purposes only, shouldn't be construed as any kind of recommendation or advice. Remember, it is not a recommendation or endorsement of any particular account type or strategy. All investing involves risk, including loss of principal. Past performance, no guarantee future results, of course. As always, remember that every time we talk about options, whether it's an index option or an equity option, options carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks. Standardized options before considering any option strategy or option transaction. Understand that there are specific risks associated with options. One of those risks, if you are trading an American style option, which the vast majority of equity options are, those can be assigned and it can be exercised at any time up to and including expiration, regardless of where they are in the money, at the money, out of the money. It doesn't matter. The majority of index options, and in fact, the ones that we're going to talk about in this webcast, are European style options. Those cannot be exercised until expiration, and therefore there is no early assignment risk associated with those. That is something to pay attention to. It is also one of the considerations that we will talk about in some of these strategies that we will discuss. So when we talk about these ideas, it's important to remember, are we looking at a European style or an American style option? Now, when we talk about also that potential risk, we're going to be using the thinkorswim desktop software platform, specifically the paperMoney version. The paperMoney version of the thinkorswim platform does not facilitate early assignment of short options. And so because of that, as you move your practice from paper trading to live trading, it's something that you need to pay attention to. There are other factors that a live trading account may do that a paper trading account does not. So we'll cover a couple of those things as we get into this discussion today. But let's pop over here to the thinkorswim desktop software platform really quickly. Let's take a look at what the indexes have been doing in the last week or so since we talked. And in fact, in the last couple of days in the SPX, kind of a mixed day today on the S&P 500 index. I'm just going to zoom in on a shorter term time frame here. And we're going to take a look at what's been going on in the last couple of days. Some strong movement up off of that 50-period simple moving average. A little bit of a bounce and some strong movement yesterday. Some strong movement today early. And then it's backed off a little bit. We're about an hour away from the close. The index now down just a little bit, 0.02%, so fading a little bit into the close here on the S&P, but not really seeing a drop off in terms of momentum necessarily. Now, taking a look at the NASDAQ, the technology-heavy NASDAQ. This is a strong move. I'm just going to zoom in again here to the upside here and see that stronger move yesterday, strong move today, although it is fading as well. Nevertheless, momentum is moving to the upside. So Greg asked the question, how do we get the year-to-date, month-to-date, and week-to-date information here? That is a scripted label. My good friend Michael Fairborn created that script. And so I've borrowed it. Michael Fairborn, by the way, teaches on Thursday afternoons, the Trading ThinkScript webcast. I'm going to go ahead and I'm going to share that with you. I'm going to share this grid so that you've got that. Now, anytime we share anything, whether it's a grid or a watch list or anything else, remember this is for illustrative and educational purposes only. It is not any kind of a recommendation, nor is it guaranteed as to time or accuracy. So your mileage may vary. Properly warned you be, says I, as you get some of those shared items. For those of you that are watching in the recorded version, I'm going to put this down in the description of this particular webcast. So the NASDAQ moving a little bit higher here. This is the one, though, out of the three. You might say one of these things is not like the other. One of these things just isn't the same. And that's the Russell 2000. And I'm going to kind of draw a line here and a line across the bottom of this little range that the Russell 2000 has been in. And it's been in a little bit of an expansion pattern just over the last few weeks. Moving to the upside, moving to the downside, moving to the upside. Now we're bouncing up against this resistance level that's kind of been in place. So on the one hand, we could probably look at this in the Russell 2000 and say, look, this is a bit of a kind of a double bottom type of potential reversal. What kind of color is that? We need a brighter color here. Let's do a brighter color. There you go. There's that bright green color. So that double bottom reversal kind of bouncing up could be the potential for a breakout. Usually when we see a double bottom pattern, it comes as a function of price moving down, and then we get a little bit of a rally up, then we get a pullback into another low, and then we get a rally up, and the expectation is that it breaks out and it reverses. Here we're not getting that. Here we're getting a move in, and then it's kind of going like this. So there's the potential here as well for this to break back to the downside. Now, it very well could be a continuation pattern. Now, my good friend Rachel Deschelle teaches, I think it's on Tuesdays, the Trading Price Patterns webcast, where she talks all about price patterns, and quite frankly, she's better at it than I am. At identifying some of those patterns. She's more of an artist, I think, perhaps than I am in terms of seeing some of these price patterns. Nevertheless, what I see is a bit of a squeeze here, that there's some selling pressure on the NASDAQ or on the Russell up here. There's this resistance level, and there's some buying pressure coming in at those lows along that support level. That's going to be an important consideration as we get to this next example, as we start to talk about this. A couple of other things that I want to talk about as we get into this discussion. Yeah, oh, it was earlier. Thank you. I don't even know what day it is. So it is Wednesdays. Thank you, Jay Richardson. I appreciate that. And Rachel does a phenomenal job. By the way, Rachel's going to be here in Dallas. She's flying in tomorrow. She's going to be here in Dallas for the technical analysis and option strategies workshop that we're doing. And I'm looking forward to having Rachel up on stage with me for a little bit. For those of you that are joining us, that should be a real treat. So we're going to pop up here to our VIX grid. I want to take a look at what's going on with the VIX. We'll back up here a little bit. And our expectation last week was that volatility was likely to rise based on geopolitical news, based on the fact that the market was, we were getting into the January timeframe where we might see a little bit of a market pullback. We haven't seen that market pullback, but nevertheless, the VIX has been kind of grinding a little bit higher. Greg, come down, get registered, register on site. We'd love to have you here. Come on down. But we're starting to see that move up into this kind of right up to about that average. and we start to run into this this moving average. This is a 30-period moving average of the VIX, which is in and of itself a 30-period average. And so you start to see that kind of run into this range. So that would suggest that we're getting this kind of upward movement in volatility. It still seems fairly cheap, right? And when we talk about volatility oftentimes leads to higher options prices. We'll see that as we look at our 14.7 strategy here in just a minute. But volatility is still in the 15 handle, which is higher than it was in the 14 handle when we started looking at this last week and putting this trade idea together. So it's going to be an important consideration to take a look at what's going on with the VIX and the fact that it is still rising. And if we see market pullback, we're likely to see more volatility increase. The next thing I want to look at here really quickly is the volatility of volatility. The VIX, the VVIX index is the volatility index of the VIX, which suggests that the VIX is becoming more volatile, which is a suggestion that perhaps it could move a little bit more. So we could see more upward movement in the volatility index, the VIX itself. So something to consider here is that possibility of the VIX moving higher and could move fairly quickly higher. Guys, we're still in a geopolitically unstable necessarily environment at the moment, where we could see that volatility up. Yeah, and JDML asks a great question. This morning, if we pop to this middle part of the grid, we had the VIX up and we had the market up. Okay, so I want to ask really quickly a question of you in light of that. I'm just going to ask this generally for all of you that are here in this particular webcast, because you are the reason why we do this and you're the driver, so you guys have an idea about these things. Why do you suppose if the market were moving higher, you might see the VIX also moving higher? It's kind of an interesting situation. When volatility rises, that can be driven by a couple of different things. It's more often than not driven by panic, but it can also be driven by exuberance and speculation. Because when you see buying pressure, so Greg, good question. Puts typically, or what drive the VIX higher, right? Buying put options typically tends to make the VIX expand. And traders, institutional traders, retail traders typically tend to buy put options to protect against downside movement. But when buyers come in and start buying lots of calls to see upward movement, that can drive the VIX higher as well. It doesn't do it as efficiently, it doesn't do it as quickly, but it certainly, if there is exuberance, meaning if the market is moving higher, some of that upward pressure comes in the form of call buying, and that call buying can expand the VIX and make the VIX higher. So JDML, that's why you maybe were seeing this morning the VIX up and the market up, or callers. Fair point, Richard, absolutely. Certainly callers being one of the means to accomplish that. So that may be a scenario where you see the VIX rising and the market rising, but it typically doesn't stay that way for a long period of time. All right, so now that we kind of have the backdrop, let's go look at a couple of the examples that we have. I want to look at, first and foremost, since we're talking about the VIX, I want to look at the trade that we currently have on the VIX index. Now, remember, the VIX index is a scenario where this is driven by market expectations. The VIX index itself is not a tradable instrument. It is an index. So this is the idea that we're trading the VIX in a bullish direction. So JDML asks the question, how does a person trade a higher VIX? Well, trading a higher VIX is either going long VIX calls, or selling a VIX spread, for instance, or doing something like what we've done here. Because JDML, the question is, remember I said that it typically doesn't last for a long period of time? When we see bullish markets, but we also see bullish or expanding VIX, oftentimes traders may, in that particular case, fade or sell that rally in the VIX, because the general relationship is if the market continues to go higher, the VIX is going to go down. So oftentimes traders will then sell VIX call spreads or sell VIX calls or trade futures. I teach on Tuesday mornings trading futures. If we use futures or discuss futures in this particular webcast, it simply is for market definition, not as a tradable instrument. Remember, if you can trade futures, futures trading requires separate trading authorization. It is highly leveraged, not suitable for all investors, and there is significant risk. All right, so here's what we have. We have a long call on the VIX. That long call is expected to get more expensive because we expect that the VIX is going up. Oh, YFT. YFT is Your First Trade. That's the show that I host on the Schwab Network. Your First Trade. Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions. So that's the index that I use, or the grid that I use in my Your First Trade shows. That's why I have it labeled as YFT, Your First Trade. That's the show that I host. All right, so we're long this call on the VIX, the 21 January expiration, 13 days to go until expiration. We bought it for $1.99. It's currently trading for $1.86. So it's come back down a little bit. In fact, you see where since we opened it, it's lost about $13. But it's up on the day because the VIX has gone up a little bit over the course of the day. Okay. What we also did is we sold a call on the VIX at a higher strike. So we created a diagonal spread. Longer dated expiration, we're long the call. Shorter dated expiration, we are short the call. And our expectation there was that was going to get cheaper. And it did, in fact. In fact, this spread is working in our favor here. The spread overall is getting more valuable. That's what we want it to do. We want that spread. We paid about $1.02 for the spread net debit. It's now trading for about $1.32 net debit. Because even though the long call has gone down a little bit, that short call, the one that we want to get cheaper, has gotten a lot cheaper to the tune of about 50 cents. So that's exactly what we want to have happen there. But we're running up against an expiration date here. So what we want to do is we want to close down this one, the one that we sold, and we want to sell another one. So in order to close this one down, we've got to buy it back. And in order to buy it back, we've got to create a closing order. And then we're going to create an order to sell another one. So we could just do that all in one order, or we could do it a piece at a time. Doing it all in one order is what's called a roll, or a rolling transaction. It's not a magic wand. It doesn't take out any transaction costs or anything else or give you any operational efficiency. It is simply a matter of convenience. So what I'm going to do, again, my expectation is still that the VIX is going to go up to about the 17 mark. So I'm going to right click and I'm going to create a rolling order, and I'm going to roll my short call, which means that I'm going to buy back the one that expires in 6 days, and I'm going to sell one that goes out a little bit more in time here. In fact, the one that goes out to the 21st of January. Now, remember, we're in this trade, we're long the option in the 21st January expiration. So we're kind of stuck here because when we make this roll, that's the last roll chance that we have in this particular trade. Because once we roll to the 21 Jan expiration, as it sits right now, what that's going to create then is a 15 strike, 17 strike long call vertical spread. And we're going to roll into that long call vertical spread, which is oftentimes what happens in the last iteration of a diagonal spread. So that's exactly what we're going to look at doing here, is creating that roll. We're turning it, you're right, Chris, turning it into a vertical spread. And we're doing it for a net credit of 35 cents, which is exactly what we want to do. We want to make this roll happen for a net credit. So if we do this, we click on, we're going to read through this order. We're buying back the 14 Jan, and we are selling the 21 Jan 17 strike call option. We're going to click on confirm and send. Now, Ban asks a question, is there assignment risk with index options? And in this particular case, there is not, because these are European style options. There is no early assignment risk, which is one of the features of index options that makes them desirable for some traders to trade, especially in shorter term products, because there is not that early assignment risk. So we take that early assignment risk out of the equation. So let's do this. We're going to roll this order. We're going to put this in our index options group. We're going to click on send, and we're going to fire that order off. We'll see if we accomplish that roll. We got 35 cents for it. So now we pop back over here to the monitor tab. Here's where we are. We are long the 15 call in the Jan 21 expiration, and we are short the 17 call in the 21 Jan expiration. And so now we've got a long call vertical spread. We still expect some directional movement. We want the price of the index. We want the VIX number to go up to 17. That gets us to our maximum theoretical gain. But look at this. We brought in, so we sold that call option to begin with. Let me just circle the numbers here really quick. We sold this call to begin with for $1.99. And then we brought in 91 cents. So we reduced that cost of that long call to about $1, about $1.08. And then we brought in another 35 cents net. So we've reduced that cost even more. So now basically we own this long call vertical spread for about 70 cents. The most that it can make is $2. Right? The most that can be worth is $2. 15 to 17, the difference between those strike prices gives us our max theoretical gain. The most that we can make on that trade, in this case, is what we paid for it minus the spread width. So we have the potential to make some money in this trade if this goes to the upside. Cool. That's the nice thing about a vertical spread, though, too, is it can potentially define your risk. We know what we paid for the trade. It's a defined risk, and we know what we can potentially make in the trade. It's a defined or limited gain. Now, so is buying VIX options similar to buying shares in something else? Well, remember, the VIX is its own instrument, right? And the VIX is going to move based on its own forces. If the market moves, the VIX is likely to move, but it is not a direct correlation. I used the metaphor last week that it is like a seal. If we think about this, this is a beach ball, and then you've got a seal that's my approximation of a seal. Here's his nose. He's balanced. He's got flippers, right? And he's got another beach ball balanced up here. So it's a seal balancing on a beach ball, balancing a beach ball on his nose. That's kind of the ephemeral nature of that relationship between the SPX and the VIX, right? And VIX options even add kind of a little bit more instability in the middle of that as well. So that's kind of the nature of that relationship. So trade it for what it is. Trade the instrument. If you have questions about trading vertical spreads, we've got a great webcast. We've got two great webcasts talking about long vertical spreads and short vertical spreads. So now let's pop back over here really quickly to our not our index options, but our index weekly options. So do I have a class that talks about the difference between long options for stocks versus index options? Sort of. Yeah, I'll show you where we can find some of those resources here in a minute. So this is the primary strategy that we've been doing on an ongoing basis here. And what the premise of this particular strategy is this. We sell at 14 days to go until expiration a short vertical spread on the SPX. We then buy that back at 7 days to go prior to expiration, come what may. So here's what we did. Last week, we sold this vertical spread at the 66.70, 66.50 strike prices. We sold that for $1.90. It's now trading for 35 cents, 32 cents, 35 cents. We're going to close that down and take that profit in the trade. So right click, create a closing order. Sometimes we've taken a potential loss in this trade. Sometimes we've taken close to max theoretical gain in this trade. Very rarely, if ever, will we get to max theoretical gain because we're at 7 days to go until expiration. So what I'm going to do now is I'm going to change my chart really quickly here. And I'm going to change my chart to my index options grid on the SPX. So if you're brand new to this, walk through the process with me and we'll repeat it every week. If you've done this before, if you've been in this particular webcast with me before, this is going to be familiar to you. So let's talk about this structure and then dig in. I'll get to your question in just a second. So I've got this time hack. On the right-hand side, this is my 3-month, 1-day chart. It's got some of the mechanics that we use to place this trade. On the left-hand side, that's my 1-year daily chart. A couple of things you see going on here. You see momentum kind of slowing, kind of see momentum squeezing a little bit here on the MACD. We also see the price kind of squeezing into a range here, maybe into a little bit of a symmetrical triangle. But nevertheless, the SPX is well above, in this case, let's pop this over and maximize this sell, well above the 200 period moving average. Our directional indicator is if the SPX is above the 200 period moving average, then we sell short put vertical spreads that have a bullish bias. If the index is below the 200 period moving average, then we sell short call spreads on the index. So since it's above the 200 period moving average, we're going to sell a put spread. And what we're going to do, I'm going to pop back over here. We'll restore this. We're going to come over to the right-hand side. The tool that I have on this right-hand chart is what's called the probability of expiring cone. And the probability of expiring cone is simply a definition of a one standard deviation curve starting where the market currently is and expanding out and getting wider as it goes out in time. So what we're going to do is we're going to look at the option chain for the SPX and we're going to say, where is our 14 days to go expiration? That's the 21 Jan. So we're going to go back to that chart and we're going to take this time hack. And the time hack is just simply this line right here. It's called a time level. And I'm going to right click and activate that. And we're just going to move that forward to the 21st of January, a week forward in time. So we're going to drop that time hack right there. Thank you, Connie, for grabbing that question. I appreciate that. In answering that question. Now what I'm going to do is I'm going to grab my line tool and I'm simply going to draw a line where these two cross over, where that one standard deviation probability of expiring cone crosses over the time hack. And you notice what's happened. I've left these hash marks in, or these hack marks in, every time we've sold this. We've been doing this for a while. So every time I've sold this, I've put that little hash mark there. And you can see sometimes when volatility is higher, that hash mark is far away from where the index is. Sometimes, yeah, that's the background that I could get to, Vic. Yeah, it's not. If you look out my window, it's kind of gray skies. I'm in Addison at the moment. But you notice that where those are is a relative range to implied volatility, basically. If implied volatility is high, that range is wide. If implied volatility is low, that range is fairly close. So here we are, and our level is this 67.30. So we're going to go to the trade tab, and we're going to go out to that 14 Jan expiration. I'm sorry, 21 Jan expiration. And I've got about 100 strikes here. I think we might need a few more strikes, 120 strikes. Actually, we need even a little bit more than that. I'm going to need 150 strikes. There we go. So here it is. It is where were we? Let me find where we were again. 67.30. So we're going to find this 67.30. There's the 67.30. Happens to be about the 13-cent delta. You notice it's got a pretty high theta component, so it's losing value as the days go by, which is exactly what we want it to do. Pretty high Vega number. It's fairly sensitive to changes in implied volatility. And we're going to sell that 67.30. And so then we're going to go to the 67.10. We're going to make this 20 points wide. So 67.30 to 67.10 is 20 points. Yes? Check me on the math here. 67.10, because I screwed it up last week. Because it's got these weird $5 wide increments there in the middle here. That is 20 points. Yes? 67.30 minus 67.10 is 20 points. So we're going to buy the 67.10. We're going to get about $1.70. Remember last week we got $1.90. A couple of weeks before that, we got $2.10. Implied volatility. Remember where volatility is? It's pretty low, down in the 15 handle. So 10-point wide vertical spread, we're bringing in $1.70. Now here's the challenge. I click on confirm and send here. My max theoretical gain in the trade, and I know that we're not going to get that max theoretical gain, but my max theoretical loss is about $1,800. But, and you're going to say, I can hear you screaming in your heads at me right now. Oh, wait a second, stop. That's a huge maximum loss in this trade. But if we look at this, we say, all right, what would have to occur? What would have to occur to take maximum theoretical loss? Well, the index would have to move from where it is down, 69.24, down to 67.30. And in fact, really to get to max theoretical loss, it'd have to move to 67.10. That's pretty significant. That's like, what, 200 points plus? Now, could it do that? Yes. Is it likely to do that? No. See where that 13 delta is? So the probability of this being at or in the money at expiration or close to expiration is about 13%. So this is a high probability trade. Not going to be a home run hitter, but it's a high probability trade. So I'm going to click on confirm and send. We're going to read through this order. As I've been talking, it's actually even come in a little bit more. So we're going to put this in our index options weekly group, and we're going to look at selling this. Now you're going to say, wait a second, I'm going to potentially lose 1,800, but all I can make on the trade is 160? Yeah, but it's a highly probable trade. We're playing the probabilities here. Now, talking about, I think one of the questions was, well, wait a second, what if I get to my profit target? I want to take 50% of that, or 75 or 80% of that max theoretical gain. Can you take it off? Yeah, you can do whatever you want. I'm not trying to give you examples of winning trades. I'm trying to give you good examples of the concept here, and that's what we've been doing this repeatedly again and again and again and again. Right? So we're going to go ahead and we're going to click on send. We're going to read through this order, make sure that it's what we want it to do. Remember that there's not early assignment risk here in this particular trade. And I'm going to go ahead and I'm going to fire that order off. And we sold it for $1.70. And we go over here to the monitor tab, and we can see what we've got now. That's the one that we closed down. Here's the one that we sold. Sold it for $1.70. Our expectation is we want this to get cheaper quickly. In 7 days, we want to get cheaper as quickly as possible. And here's one of the reasons why it does that. And one of the reasons why we choose 14 and 7. And why I use that weekly time frame. Yeah, so digging, yeah, again, you remember, if the VIX is going up, that's going to go against us, or could potentially go against us. So you got to be aware of that if the VIX does rise. right? So is there a debit version of this strategy that would make sense in a low IV situation? Yeah, just flip it over, right? Create a long call spread, buy a cheap long call spread and expect some movement. And that would be a possibility as well. So here's the reason why this potentially works. So here's that curve that we're normally used to seeing, right? That normally we're used to seeing this kind of time decay curve, right? As we get close to expiration, time decay bleeds away quickly as we get close to expiration. That's the curve for an at-the-money strike or for an at-the-money option. But the curve for an out-of-the-money option, especially a far out-of-the-money option like the one that we're talking about, 200 points out of the money, looks more like this. If there's our expiration out there, the time decay curve for that out-of-the-money option looks a lot like this, where the majority of the time decay happens in the first third or first 25% of the time frame. So we're capturing the majority of the time decay in that first little bit, and then we're avoiding this part right here where it just kind of sits there and stagnates. That's the reason for the 14.7. We're trying to capture that initial rapid time decay on an out-of-the-money option. One of these days, we'll talk more deeply about the math behind this. I had a good conversation with my dad over the holiday. My dad's a biostatistician who got me involved in trading options when I was 16 years old. But he and I had a good conversation about the reasons why this math works. Yeah, you could certainly use the market maker move, or you could use the expected move. That's a way to do that as well. Certainly a way to accomplish that as well. So I want to talk a little bit about the math when we have some time to do that. But that's kind of where we are at the moment. Is we've got those two ideas working. Now, the other one that I wanted to look at, remember, was the Russell 2000, the RUT, the Russell 2000. Remember I said that the Russell 2000 was kind of getting squeezed in that range there? So my thought was, in doing this, was the idea of creating an Iron Condor, for instance, in this particular case. So what we're going to do is we're going to go to the trade tab, and I'm going to go to the Russell 2000, and I'm going to go out. Actually, in this particular case, I'm going to go out. You know what? I think maybe we'll go even a little bit further. I'm going to go out to the end of January here in this particular case. And the reason for that is there's a little bit of an elevation in implied volatility. Maybe we'll go to the 6th February. Those options are a little bit more expensive, but we'll see how liquid they are. They're still pretty liquid. And what I'm going to do is, as we look at the chart, I've got a resistance level up here at about the 25, we'll call it 2,600. And I've got a support level down here, maybe around the 2,480. So let's do the call side first. We said that the call side resistance was up here around we'll even call it 2,600. So let's go down to the 2,600 strike. We got to scroll way down here. Here's the 2,600 strike. That's the 45-cent delta. So we're going to sell that. I'm going to hold my control key down. I'm going to sell that 2,600 strike, and I'm going to buy the 2,610. We'll make this 10 points wide on either side. So we're going to do that for $4.45. Now, click on confirm and send. Max loss in this part of the trade, $555. Max gain, $445. We can do better. So what we're going to do is we're going to add to that. That's the short call vertical. We're expecting the price to go down. Now we're going to go to, where did we say on the chart? 2,480 down here at that support level. So we're going to go to the 2,480 strike, which is down here at about the 20. So this is going to be kind of an unbalanced Iron Condor. We're going to go to the 2,480. We're going to sell the 2,480 at the same time, and we're going to buy the 2,470. So now we're bringing in a total. We've got a 10-point wide vertical spread on either side. We're bringing in $6.50, which now shifts the equation. Now we make potentially $6.45, and we lose potentially $3.55. It's aggressive on the upside, not as aggressive on the downside. So if the expectation is the bounce to the downside, if this bounces down from that resistance, then it's going to put it kind of right in the middle of that range. If this starts to threaten our top side call vertical spread, we can adjust it. Okay, so I'm going to go ahead and I'm going to put this in our index options group. And before I send that order off, I'm going to do this. I'm going to right click. We'll send this to the Analyze tab really quickly, and we'll just take a look at this, and we'll hide our positions, and we'll just kind of see what that looks like. So you can see how wide this trade is, how wide that range is. If we do this, we'll go out to, where were we, the 6th of February. There's our expected range. Let's set our slices to break even. And you can see where those break-even slices are in this trade. If we go, let's do this. Reset slices, and let's go set slices to break even. And there's our break-even slices. I think that's a little bit off. But nevertheless, we're going to see that range. You can see how wide that Iron Condor is. So let's go ahead. Let's pop that order back up, and we'll fire this order off. And we will send that to our index options group. We'll keep an eye on that. We sold it for $6.45. The expectation is that the price is going to stay within that range. Yeah, we might break, Laura, and that's a very good point, right? Is adjusting that maybe out to the upside a little bit more, right? So shifting the goalpost a little bit higher, something that we can pay attention to as we manage this next week. All right, so that's what we've done as we look at this structure today. We rolled, closed our 7 days to go until expiration vertical spread, sold another one. We adjusted or rolled our VIX spread into a vertical spread. It was a VIX diagonal. Now it's a VIX vertical. Because both of those expire in the same expiration time frame. We rolled what was a diagonal spread. We rolled it into a vertical spread, and then we added our Russell 2000 Iron Condor. Expectation is that the price of the stock, or the price of the Russell 2000, stays between 2480 and 2600. So we've accomplished a bunch of things here today in this discussion. My thanks to Connie Hill for helping out. By the way, if you want to learn more about this, come on over here to the Trader Talks webcast page. If you want to learn more about those strategies like diagonals, just type in diagonals. Oh, and when you're here, give us a follow. Just click on subscribe and follow us on the Trader Talks webcast page. You can also learn about things like Iron Condors, those types of things. But if you want to join us and to answer Sal's question about what makes a live event, in-person event different, it's us up on stage teaching these concepts. It's a different way to learn. Some traders like that way of learning more so than just doing a webcast because it's more interactive. But if you're in the area, come and join us. We're going to be here on Friday and Saturday. We are at the, right here, let me pop that open. We are at the Renaissance Dallas Addison. We start at 9 o'clock. Come on down about 8 o'clock. We'll feed you breakfast. We'll feed you lunch. Lots of great stuff. We will see you then. My thanks to Connie Hill for being here. My thanks to all of you and to our great production staff and our great reviewers. Thank you again, and we will see you guys very soon. I will be back next Wednesday for Trader Talks, or for Trading Index Options. I'll be back next Tuesday doing the Trading Futures webcast as well. So we'll see you then. Take care, everybody. Bye-bye.